Hey, welcome back everybody to the Bear Trap Discord podcast. My name is John Kirby. My co-host is Vic. All chart credits as always go out to Ock. A lot of the charts in this episode are actually coming to us as a courtesy of Doc McGraw, who's our guest for this episode. We've been trying to get him on for a while. Doc writes the daily planner most days, I think every single day to be honest, in the Bear Trap Discord. And this episode we're going to kind of go through a lot of the charts that he's looking at and to see how he thinks about trading, right? It's one thing to read his daily planner. It's another thing to get it from the man himself. He's been doing this longer than any of us, really, and has it down to the point where he can keep all of these different spinning plates spinning and know what's going on at the same time. So I think we all have a little to learn from Doc at least. We also wanted to use this opportunity as a way to just analyze the last couple of days. We just went through VIX X and then the OPEX, as well as having a bit of a crash due to a Fed speaker that came out on Thursday. And we wanted to take this opportunity getting into the window of weakness now, right, where options have less of an effect, to look forward into the February 28th expiration and see what Doc sees on the horizon. So we kind of pushed him to make a couple of prognostications along with us, even if they're just about possible distributions. In any case, that's long enough for an intro. I hope you guys enjoy it, learn a lot for it, and come back to part two. I segmented it. Enjoy.
Hey, we back once again. Bear Trap Discord podcast, and a special guest with us, Doc, from the Discord, and we got John Kirby as usual. Let's get going, guys.
Yeah,
what do you got
welcome.
on the slate for us here, John?
Well, honestly, most of these charts come from Doc. I think he has, right, he's been doing this longer than any of us, so he has all these resources. So basically, he's going to be guiding us through them, and then we're going to be guiding him through a couple of our charts and just talking price action and so forth.
I'm excited. I'm glad to have you here, Doc.
Thanks. Good to be here, and I'm probably the least systematic of the crew here, so I'm just going to kind of be bouncing around and following your lead, although I'm going to try and lead everybody through a little bit of the thought processes and how I do my trading and make my my decisions, and how I use options, gamma, open interest, and flow to kind of help guide my decisions, along with like what in my planner you'll see me call TA 101, like basic technical analysis, nothing fancy or trend lines or anything, just pretty much look left.
Yeah, no, that makes a lot of sense. I think that I may start actually by getting us a little bit of context and just looking over at the the ES chart that I have up here, which is a little bit messy, but just so that we know kind of where we're at. And it's just this really, really big consolidation. We came up, we broke that trend line everybody was watching. Now we're just consolidating above. We had a couple of bearish candles after CPI, VIX-X, and OPEX, and now we're basically looking forward at the window of weakness, and we're going to try to get a read on what's going to happen into the 28th, right, Doc? I think that's the expiry.
Yeah. Well,
cool.
The 28th is going to be the next sort of inflection point, and maybe we'll talk about that as well, just sort of once we do a little intro into the basic gamma market structure, kind of what the inflection points are and kind of potential warning sign road posts or green lights are that are coming up.
Yeah. All right. Well, then I'll take it to the.
Let's start with the simple OI chart. Is that it?
Yeah, this one right here. Yeah.
Okay. So, but OI is open interest. So this is basically a chart of where, hyperbolically stated, all the open interest on the planet Earth for SPX is concentrated. Not all. There's going to be some way out of the money and in the money, but the stuff that's closest to us. And what you see, and price action has been telling us this, look at 4,000.
Yeah. So there's
4,000, the biggest bar on the chart, sucking all the oxygen out of the room, kind of, is 4,000. So now the green are calls and the blue are puts.
gotcha. Yeah. And
And
spot
puts
is
are below the
closed
line
on.
inverted just to make it easier to see.
Uh-huh.
So those are long puts. The assumption is people are long on those puts and own those calls, and market makers are on the other side of that. We may or may not get into that. But what is important to point out here is that market makers, dealers, have to hedge based on the open interest that's at the various strikes and how spot price moves in relation to that. So what this is showing us is what we've been seeing certainly the last couple days. 4,000, that's the line in the sand that we're not supposed to go under.
Mhm.
40.50 has been holding, which is right there. Couple more puts and calls, and we'll get into what happens when we get closer to the 40.50 and the market makers have to start shorting. And if we break that, that's when they start to really have to start shorting more, and we get sucked down to that 4,000. And the flip side of that is as we get above 40.50, the green ones, the calls, those calls start to get higher delta as we go up in price. The delta of the call increases, which means market makers have to keep buying to keep their deltas neutral. I don't know if I'm assuming that we have those basic concepts down. If not, we can kind of backtrack to it. And then 4,100 is the next big level. So we're nicely apportioned at these, you know, 4,000, 40.50, and 4,100 strikes. So it kind of makes trading and discussion a little easier. Okay. Any questions, or should we go on to the next slide? Do you want to explain something?
No, that makes a lot of sense. And would you say that like I guess these are slightly more put dominated than call dominated, or is that something that we're going to get into later?
Right. They're slightly more put dominated. We'll get into that a little bit more when we look at the net and at the gross and net gamma of those. Um, but what's important to remember is going to be the dynamic interplay of those, which we'll see on the net gamma versus the gross gamma. By that I mean as we're moving up, the deltas of those calls are going to be going up, and the delta of those puts is going to be going down, and vice versa. So that's going to be moving, but that's going to end up being sticky.
Okay.
And
What do you
how
mean by
that
sticky?
moves is going to kind of determine what happens, and the daily options flow is going to be what helps us break that or not. Okay, so let's go on to the next slide.
All right. Let's make sure this is the right one. This is net.
No, let's go to gross first.
Gross. Okay.
Okay. So what you should probably notice is that the gross gamma looks roughly the same as the open interest. So now, what most people, if you're familiar looking at gamma charts, you're looking at net gamma, which we'll be talking about on the next slide. And basically, net gamma is add and subtract the deltas of the puts and the calls. What's left in the book. So let's just say hypothetically the market maker has an equal amount of delta at the same strike. They cancel each other out. Then as spot moves toward it or away from it, then they're going to grow and it's going to change dynamically.
Yep.
So the gross gammas are showing us kind of what we already know, that the 4,000, the same strikes, pretty much the same distribution. It'll be a little different in that the closer we are to some of those levels, the larger the bars will be here. So, for example, the 4075, I'm guessing it is the one that's in between the two.
Mm-hmm.
Uh, that over.
Over here.
Yeah, kind of where we closed. That is bigger than it is on the open interest because we're closer to it. Gamma is greatest at the money and shortest in time. So the closer we are to a strike, the larger that gamma is going to be, of course, weighted by open interest.
Yeah. And just to, I think this was in what you said. But just to further clarify a little bit, right? Even if at a particular strike as a dealer, right, your deltas are in equilibrium, they will go out of equilibrium as spot moves,
Exactly.
and that's why
Exactly.
we want to look at this gross gamma, and then this will reflect if there's a disequilibrium in gross gamma. In other words, it'll tell you how much your deltas are going to get shifted, so to speak, by spot moving.
And so when I do my daily prep, I like to glance at this, which tells us what we kind of already know, where the gamma is. And then when I look at the net gamma, which will be the next slide, I kind of have this in the back of my mind because that tells me how things are going to shift. So next slide, or
Okay.
actually previous slide.
Yeah, sorry about that.
Okay, no problem. So now suddenly we're looking at net gamma when we subtract the puts and the calls and kind of, add it all up, and we get a very different picture than we just had.
Yeah, I'm seeing. I mean, you see that the 4,000 strike is actually. I mean, we saw that, right? I guess it's negative, and then we have some. There's more positive gamma than I thought, all the way up here still, 4,200.
Right. So now suddenly we know something is going on there, but we also know to keep an eye on that 4,000 strike as we come down. What's going to happen is that those deltas are going to get more and more negative, and dealers are going to have to short more and more if we break that 40-50.
Mm-hmm.
If we break that 40-50. And you see where we have those like little spots, where like the bars are kind of small, like kind of in between where the price, like those places.
Mm-hmm.
Those are sort of, in theory, default resting spots. All things being equal, market makers want to park it there. Not that they're manipulating the market, which some people like to think, and one of my pet peeves is what I'll call the victim mentality and the 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 game is rigged by them, and so what's the difference kind of thing. It's just that their hedging is going to naturally steer them in that direction because that's where they have the least work to do. That's where they have the least buying and selling to do.
Yeah, that's. I mean, that we
I have a question real quick. So this big positive here that's sitting at 40-60, it's like right before the 40-50. Is that sort of acting like a support, pushing it back towards that neutral zone?
Yes, yes. You can think of that as a support, and you can also think of it as well. It was a springboard once we got over it, and that kind of helped propel us upward. And think of it as a support, and think of it. It's pretty close to the money, so I'm going to guess. I mean, those are 60 delta, 40-60s of different strikes, so they're different deltas, but we're going to call them roughly a 50 delta, 55 delta. So as those deltas grow, as we go up, let's say 10 points, and that becomes, I guess, call it a 60 delta, a 65 delta, that's a lot more hedging that they have to do. However, gamma is the rate of change, and so as we go from 65 to 70 to 80, it has less influence. And then what ends up having the more influence is the next man up. So the next man up looks like it's around 41. I can't really see where the lines are, but the next green bar on top, as we go up, those deltas are going to increase. That's going to need more and more hedging, and that can pull us through it.
Doc, can I add a little
Sure,
something
please.
there, which is that they're actually a 64 delta, so you were off by a whole 4 delta there.
Oh man,
Yeah,
depends what
get it
explanation you're
together,
looking
Doc.
at.
Come on, man.
The man, he just he has it all. He can do it in his sleep. You just know. Um,
Yeah, no, that was definitely close enough on the 60 delta there. That was good enough. Okay, so that's awesome. I love knowing that kind of stuff. And then so looking at this distribution, would you say it looked just on the face of it? Does it look bullish to you or bearish? Or how would you kind of glance at this and say?
That's a good question. It looks precariously bullish,
Good, I
and
agree.
I'll tell you why. Okay, well, I have to temper my perma bull.
Hey, no, you told me to get
I'm
long
an
after
optimist
Christmas,
in
man,
life
and I
and in
didn't believe it.
trading, and I have to be aware of my own personal psychology. It's it could be bullish with an asterisk. What do I mean by that? You see all those calls that are out of the money.
Oh yeah, there's a lot of them.
Okay, so those right now they're far out of the money, so the dealers don't have to worry about that. Those whatever they bought when we were at 4,200 a few days ago, they got to sell to kind of neutralize their book. But the stuff that's close, like where's your cursor right now? What strike is that?
That's 4150,
41.
4160. Yeah.
Okay, and I'll go right above it. So I guess it's 4175 above that. The next big one.
Yeah, actually, yeah, I think no, those are 4160s, and then up there, I guess it's 4190. So
41. Okay, so and you'll often see me talk about this in my daily notes. And let's just pretend hypothetically that we're going into the open on Monday or Tuesday. All right. And we see those 4190s and, I mean, what are they 4090s and 4100s, whatever the stuff is that's just kind of out of the money.
Yeah, because we closed at 4080. So
Right.
yeah.
So that big bar there, that big bar right there is, you can see my cursor.
The big bar that I'm on is the it's the 4160s right here.
Oh, wow, 41.6 is that far away? Okay. So what's going to happen if we open, if the futures are down even 10, 15 points between the passage of time decay, theta charm, let's just call it decay to keep it simple, whatever the market makers had to buy to hedge that, they get to sell, which kind of drives us down.
So is it fair to say that like we actually have an issue if we have so many calls up here and we don't start moving up quickly, then the index is sort of under pressure?
Yes. The dealers get to sell their long, so the index is under pressure. So if the open is a little red or a little green, it makes a big difference. If it opens a little red, then some of those bars that are under the midline are theoretically bigger. We have to, you kind of have to picture it dynamically that those bars that you see there are then going to be bigger, and the market makers are going to have to hedge in that direction by shorting more. Then we hit that inflection point like we did Friday, 40.50. That was a big level. And then we kind of had the market maker bull bear, battle there. And that didn't break. It wobbled there a little bit. And then we just kind of naturally drifted up.
Gotcha. That actually clarifies something that I was wondering, because I remember you asking about whether they're hedging overnight or not, right? Whether the dealers get to rebalance their books overnight, or like when that happens. And that this is a really cool intuition that if we open up or down a couple of points, that it actually makes I mean we see it at the open, right? All that volume come in, I guess. But I guess I always I hadn't really necessarily made that connection that it's So is that something that do you still think that they're not doing it overnight?
Yeah, that's something that I think. I don't think that they're taking that bet. There may be one or two things when like London opens or whatever. Some of like the foreign desks are doing a little, a little bit, but they're not going to guess where we're going to open because we often see we can go 10, 15 points in either direction in those last half hour before the open.
Yeah, no, that's totally fair. And then on top of that, also,
And
I mean,
you'll often see, and pardon me for jumping in there, you'll often see on my daily note, I'll say something like pop and drop or drop and pop or whatever. What I'm anticipating there would be the drop at the open, let's just say, because because we're looking to open a little red or sometimes even flat. If there's more calls up there and there's some decay, dealers are going to get to short it, and then we're going to likely reverse or chop or what's going to happen. And when we get to some of the internal stuff later on, I've been noticing that on the advanced decline line.
wow, that's super cool. Because I'd always thought about it as I thought about it a different way. Like, oh, we open flatter. Like, let's say we open up a little bit and people are in calls, then you get a bit of an initial drop because they want to liquidate, and then you pop afterwards because they get right back in them. But it actually makes a lot more sense to think about it your way. It's like depending on where we are, as the first move is like the dealer rebalancing move.
Right. First move I think of as a dealer rebalancing. I don't think that they can jump in that fast to make a 10, 20 point move. And also, especially in the weekly options, if you look at the volume, for like a random Tuesday or whatever, you might see, 3,000, 5,000 open interest near the money at like the main quote unquote strikes, like the quarter strikes or the half century strikes. That's really not enough to create that big of a response unless like everybody's hitting the button at the same second. Now, there is monetization, and that comes in, and that's part of what you're talking about, and that kind of adds fuel to the fire in the direction. But I always think of it as the initial hedging response.
That's awesome. Cool. Should we move to another chart?
Whatever we got next on the hit parade.
So I have on the hit parade. I have those charts from Friday as well. But I don't know. Here, let me go through them really quickly. Okay. We had, and this was OPEX, right? This was Friday, the 17th of February, for context for everybody.
Right.
So we have this one, and then the monthlies and weeklies volume. If you want to go into that, otherwise I can.
Let's start with this one. And okay, that was volume. Okay, so what I was doing here, and I'm just kind of gonna walk people through if they look at my daily planner, and there's a vague order that I put things in, but it's not always the same. So what I'm looking at here is the volume. So that's the volume of what happened the day before. So I look at the updated volume, and this is inverted. So we see all those puts added at 4,100. But you see, I have the 40-50 highlighted because I knew that was going to be the battle zone.
Mm-hmm.
And so all those puts were added right there. No calls were added. Nobody was interested in that. Calls were sold. And so what that creates is, yes, that magnet down, but on the other side of that, if we can manage to stay above that, then we start to drift up.
So what's interesting here is we saw the net gamma chart, but you're seeing that in mass they were selling calls, even with the net gamma being essentially overweighted in positive gamma, I would say.
Yes.
And so what kind of scenario could that present for us? I think you're going to get to that, saying, hey, if we can stay up, it sort of creates more of like a right tail type of risk, maybe?
Yes, exactly. It creates a right tail risk.
And so the key point then would be, hey, we can get back over this 4,100, and now you're talking about puts getting squeezed again.
Yes, exactly. All those puts that were added right there. This is just was added to OI, and I'm not sure if I put a general open interest chart up there, but if you just kind of see the little tabs on the top there, what I'll do is I'll look at, there's one tab there that says volume, so that's from the volume chart. Then I'll look at open interest, so I'll see, okay, this is what's here now, but this is what was added or taken away, and kind of try to balance that out in my head, which direction we're going.
So something that Jim Carson was mentioning in his latest interview was that we're in this window of weakness, and if the Bears essentially, or we can't get a catalyst, or the Bears can't make it happen, there could potentially be another big squeeze here shortly,
Right.
especially into the end of February.
Yes, and I wanted to get to that. I just listened to his thing again. I also
Okay,
have
good.
a little bit of money in one of his hedge funds.
Oh yeah, nice.
Partially because I want access to him as a customer. I can do a Zoom call with him. I mean, in theory, anytime I want. In practice, I usually do one with him once a month, in which when I cross-examine him and ask him very micro
Wait, you
trading
actually get a
questions,
Zoom
which he
call
tries to
directly?
avoid answering and wants to stick with the macro stuff.
Wait, so you actually get a Zoom call with him once a month?
Yeah, I have a Zoom call with him every month.
What?
Yeah.
Yeah, Vic, Doc was kind enough to slip in a question of mine last time,
Yes,
which was
yes.
really useful.
Is that right?
Yeah.
Oh, that is so cool. Dude, Doc, can you get him on the podcast?
I don't know if I can
I think we're too small, Vic. We're too small.
What I can do is see if he'd be okay with me recording one of our phone calls. I don't know if he'd be okay with that or not.
No, don't. I'm just kidding, man. It's just I'm just dreaming is all. It's all good. But oh, that is so cool. Okay, cool. Yeah. Well, you're gonna get to that. I was just saying it because like the picture becomes clear as we go through it, why he's saying that stuff. So
yeah, and when we'll maybe we'll go back to another general gamut chart, and we'll another net gamut chart, and we'll talk about it. And I know I'm jumping around a bit, but that's just kind of the way my brain works. You'll also notice in my daily note, I might post different time frames. I might post the daily gamma structure, option structure. Then I might look at February 28th and the March AM. I'll look at some of the big ones to try to get like a feel for the path that we're going in and how we might get there. So how Jem sees that window of weakness, or the window of non-strength is what he actually called it, window of non-strength, and then possibly leading to strength again if we don't break that key strike, which pretty much we all know is 4,000 at this point. 3,900 even more so, but 4,000 is the first, real line in the sand.
Yeah, I mean, looking at the well, I mean, I was just thinking as we were looking at this chart, I was thinking back to the Friday price action. And maybe I'll hop over there so that we can look at it and map on.
Okay, so this was volume from the day before going into Friday. So jump to a different slide.
Okay. We have this one as well, but this was also from the day before, right? So maybe I should jump back to the net gamma picture.
Well, while you're doing that, let me look in there and see. Maybe I copied the wrong slide by mistake. Hold on.
Okay, gotcha. No problem. Yeah, I'll get this onto
themselves, as they say.
I'll get this onto a tick chart from Friday. Let's see.
Does that net gamma chart, is that what kind of time frame is that over?
Well, that particular service just nets it out all the gamma,
everything. Okay.
And on the planet, so to speak.
Gotcha. Do you ever break it out by expiry, Doc, and sort
yes,
of like
I do all the time.
Yeah. Okay.
All right, I got us here. Yeah, and then I guess we can check to see if that's the one. But
Yeah, throw that up for a second.
all right, perfect. Thanks, Doc. All right, you guys can see that?
Okay, so that was going into Friday. See, it says net gamma all expirations. There's a little drop down there that I can pick what expiration I want to see. That's a different service. I use lots of services, and let me start with the disclaimer or caveat, whatever you want to call it, that all of these services are pretty much looking at the same thing. Open interest times gamma, open interest times gamma equals a number. They might have little tweaks to the way they treat the numbers a little bit, but it's a pretty basic calculation. So the reason I use different services is because they just give me different ways of visualizing the data. On one service, I can see, let's just say, this kind of thing. Another service, I love Gamma Edge. They give the wing charts, and it helps me think in the dynamics. And since this is my bread and butter, I mean, I'm retired, but this is what I do for a living, and I trade a pretty decent size, not huge, but decent enough for it to be worth it for me to spend the extra $100 a month for a service and to have 3 or 4 services. If I'm spending $500 a month on services, that's my overhead to keep the lights on if I had an office. Not even.
No, that makes sense. I mean, we've talked about this a little bit on the podcast, how because options are such complex instruments, the reality is it's almost 3 or 4 or 5 dimensional. And so that's why we also take, open interest and the delta hedging, then the gamma hedging, then the, and so I think it makes sense. If you're looking at all this, you're kind of getting an image of the landscape because each one's 2D, but you're putting it all together. That makes a lot of sense to me. So Doc, what are we looking at here? This is the one
Okay,
from
so this
Friday,
is Friday. Right? This was what we were looking at coming into Friday.
Okay, cool.
Okay,
so I see
and this is all expirations. This isn't just Friday expiration. But since gamma is greatest, closest in time, and closest to the money, this is what's going to have the influence. And we know we have big open interest in March, Feb 28th, whatever, that's going to influence it, that the dealers just can't ignore and pretend isn't there. They have risk managers. They have to come home at the end of the night, so to speak, and honey, are your deltas hedged? Yes, they are.
Can you imagine if your wife said that to you?
You'd be like, shut up. I have an appropriate level of risk on. Wink, wink.
Right. So if you notice, it says gamma flips at 40.82. Now that's not, to the penny. Again, different people are going to calculate it differently, how many expirations, whatever. And we closed at 40.79. We closed right at the neutral zone. Just where before I mentioned, that's kind of one of the places where they're going to want to park.
Yeah, and it makes sense for OPEX especially to be a pinning day, right? Because we have so many things expiring on both sides.
Right. So that's where we're going to park. So I just wanted to kind of illustrate where we were on Friday. And we have that big 40.60 strike, which really should be 40.50. I don't know how come. Yeah, on other people's charts too, it came out at 40.60. I guess it's the math.
No, I think it's just that they're not labeling. They're labeling every 15 points on here. So this bar, I think, is at 40.50. It's just that the label's
got you.
40.60.
Just the labeling, got you.
But I mean, it's no coincidence. We came right down. I think the low of day on Friday was
like 40, 48, 47. I was watching that real close.
40, 47.95. Yeah.
I was in broken wing butterflies on the put and call side, and I was getting ready to dump one or the other depending which way we broke. So as 40.50 kind of wobbled and held a few times, I sold the put broken wing butterflies for a smallish profit, got out, and rode the calls up.
Oh, beautiful. Yeah. Yeah, it was a wonderful day for that type of for your type of trading as well, I think.
Yeah.
Not so much Thursday, I think.
No, Thursday was kind of a rough day. I survived, but it was kind of a rough day.
Well, it's the Fed speakers, Doc. They just come out and do whatever they want sometimes.
Yeah, apparently so. Yeah, and again, in retrospect, let me take a quick look at the. Yeah, okay. So I mean, what happened on Thursday? I don't know how many people listening have like the daily chart emblazoned in their brain, but
Sorry.
what happened on Thursday? We had Meister, however you pronounce your name, in the morning, talking about 50 basis points was what she, wanted. And we kind of went down, but we kind of wobbled. We held that 40-20-ish. I mean, 41-20, 15-ish area. 4100 was the big monster in the room. Once Bullard came on and reiterated that and took his usual hawkish stance, then we started breaking down. Once we started approaching that 4,000 level, the gamma, the magnetic pull, the reflexive dealer hedging required to keep shorting as we kept getting closer and closer to 4,000, just pulled us more and more down. And then the more hedging there is, the more selling there is, the closer we get to that 4,000 strike, the delta goes from 65 or from 35 to whatever it is, getting to 50 delta max hedging. At the same time, the calls are losing their delta. Dealers are selling whatever they have to hedge that. So you have double selling going on by the dealers, and you have the price action people who are trading, buying puts or selling futures or whatever. So you get this like vortex of, and you have algos jumping in, trend following algos, and you get this vortex of stuff that was sucking us down to 4,000. I kind of pretty much knew 4,000 was going to break.
4,100, you mean? But yeah, it was. Is it? What about zero DTE? How is that come into play on a day like Thursday?
Right.
Are people just going? Is that why we see the volume crazy at that 4,100?
Yeah, and usually they, the volume tends to come in at those century strikes or quarter strikes, whatever they are, and then I'll often look in the volume. I have different ways I look at volume, but sometimes I'll do what me and Hammer jokingly call caveman style. I'll just literally pull up an option chain. In Tastyworks, you can click on the option chain, and get a chart of the option, and so you can just see the volume and the price.
Yeah, I've seen those charts before. I think you've posted a few of those.
I'll pull one up right now so we can take a look at it. And
something I want to say is
pull up a random one, whatever.
Yeah. On Thursday, there weren't a lot of puts to come into the day, which was interesting. It was like it's pretty neutral for the day. So I think what happened was, people are just loaded puts because there weren't a lot of puts already.
Usually I'll do intraday. I'll do a day 1 minute or maybe 5 minutes. I just want to get a feel for where the action's been.
Okay. Oh, that's cool. This by the way, this is just Friday, so it's not the Thursday that we were talking about.
Okay.
But let me see if I can get that Thursday.
Oh, you can go back in time.
Well, just a little here. But this is the problem is that this is the 75 put, because to go back in time,
I can randomly pick one, right?
I can using on demand and all that stuff, but it'd be kind of annoying. But the point is that at least on this particular put, which was the 4075 expiring on whatever that is, it's in 3 days, so it's on Wednesday of this week. I can see what you're talking about. You're looking down here, right? Like at these volume bars here?
Yeah, I'm looking at the volume bars. And you can look at the price chart as well. You could see, when you see the volume bar and the price go up, well, we don't know exactly, but obviously people are buying them. Otherwise, price wouldn't go up.
Yeah, it's kind of interesting that I know this is going to sound stupid, but to some people maybe, but that the price is going up without any volume. Like you don't see that in other assets, right? Like in an equity, you'd expect to have volume coming in order to move price at all. Otherwise, it's like a gap up or down. But here, right, as like market makers are adjusting their quotes, and so the price is
Exactly.
changing,
Right.
but the volume only actually comes in at 330 here. Um, I don't know. I don't know if that's interesting to anybody except for me, but
What day is that right there that you're looking at?
That's Thursday. So this is a put, and it just like
Gotcha.
ramped into the
Yep.
close on Thursday.
Yep.
Yeah.
So they saw it coming before everybody else.
Oh yeah, absolutely. So I was watching, and if you were observing skew on Thursday, let me get us back on SPX. So okay, this consolidation right here, from around 2 p.m. until 2:30. The puts were getting loaded. There was an insane amount of volume on the put side, and skew was reflecting that. And then
So as prices traveling up slowly, you're seeing skew, basically shift to the left, right?
Yeah. That was interesting. Or basically, it was kind of like, or rather, it wasn't shift to the left, right? So usually we want to see, like, in order for, sorry, this is a little bit of a tangent, Doc, but in order to see like an all-out crash, right, we want to see the calls start to kind of curl up a little bit in the overall chart. And what was interesting about this particular circumstance was that it's kind of the same as that option chart that we were just looking at, where the option, like the price on the option was actually going up before the crash was coming. So people were just loading into puts. So actually, I don't know what the calls were doing because I wasn't even looking at that, but the put skew was just coming up and up and up. Does that make sense?
Yes.
Okay, cool.
Yeah, and you can see that if you just watch the options chain, you can see that happen a lot of the times.
Okay, so what I just posted there, and this was, this wasn't planned. This is an option chart of the 4,000 chart for this coming Friday. And I just put a 5-minute chart one day. So this is what happened on Friday of buying and selling of the option for next Friday.
Yeah.
Okay, so we see at 11 o'clock, there was some big volume coming in of buyers of that option. That little yellowish tan line on top, by the way, is VWAP. I just want to be able to quickly, easily see what the prices are. It's not going to act like VWAP on on like an ES chart, but it just gives me an idea. And you see, at the end of the day, those were dumped.
Yeah, it's almost an inverse of the actual chart itself. You actually see sort of a bullish divergence there.
Now, to be fair, we don't know if they were dumped or if just the price has gone, because the bars are going to be colored based on open close of that bar based on price. So if the price went down because we moved up, and so the deltas of those options became less, it's going to look like they sold, but we don't really know that. But it's just kind of, when you're looking at that on 0 DTE for the action of the day, you get a much better feel.
Actually, I mean, Doc, I think this shows us what you're talking about, because this big volume bar right here, which was what, it was at 330 or so.
Yeah, I would think they dumped them. Yeah,
they dumped them. They 100% did, because right, if they had wanted to dump them, because there was a squeeze or something like that, and they wanted to get out of them, they would have dumped them at 310, not at 330 or whatever this is, because we were all up there consolidating the whole time into the close. So at this point, somebody made a decision to get out.